Behind the curtain of the most powerful organization in the world, the Federal Reserve and their ability to set the price of the dollar. The Fed has absolutely massive, untold power in their ability to determine and set the price of money and the price of the dollar. One of the most powerful abilities in the world, but how exactly does it actually happen? Today, we'll look at some of the tools the Fed uses and dive into the plumbing of the modern day financial system. So when we talk about what is a dollar worth, a lot of people will think in their head about $100 bill. And while that is true for most normal people, the value of a dollar is actually different. The value of a dollar has an interest rate. There is a cost or a value to that dollar. And now you might be thinking, okay, you're thinking of the 10-year treasury. What is the interest rate on that 10-year treasury? Well, that's partly true, but you're talking about 10 years, a dollar for 10 years. And so you got to worry about duration. There's like two presidential terms over 10 years. You got to worry about duration risk, term premia, inflation, fiscal concerns. There's all sorts of other concerns with using, say, the 10-year treasury interest rate as the price of a dollar. So, what is the most short term loan possible? Well, it's overnight. So, in the video we did on the repo market, this is all kind of that overnight dollar market. And it is the value of the dollar itself. By the Fed using their tools, they are setting the price of the dollar itself. Now, I think it's important, a lot of people think of the Fed funds rate and they think it's a rate. And there is the effective federal funds rate. Here we can see 4.33. But if you look at the actual FOMC statements, the Fed actually sets a target range for the federal funds rate. Right now, it's 4.25 to 4.5. So if we go back here, we can see that 4.25 here is the reverse repo award rate. So what is that? We'll start at the bottom and kind of work our way up. So the reverse repo rate, this is the cost of money that the Fed is willing to pay. So just as we talked about the repo market, this is the reverse of that. Let's say I'm a money market fund. What the reverse repo market is I have dollars. I'm a money market fund. I have $10 billion that I'm not using. I can go to the Fed and loan those $10 billion to the Fed. And this red line, or the reverse repo rate, will determine what I get, what the Fed pays me in terms of interest. And so by doing this, the Fed is setting a floor in the value of the dollar by basically saying the dollar can, an overnight dollar can never dip below 4.25. They are effectively trying to set a floor in the value of a dollar on an overnight basis. Okay, so that's the reverse repo award rate. And sure enough, 4.25 corresponds to 4.25, which is the lower end of their range. Now let's look at SOFR. So SOFR, we've talked about in other videos, but just briefly recap, this is the secured overnight funding rate. This is also the price of an overnight dollar, but it's secured. So there is a treasury security or a mortgage-backed security backing up that overnight loan. And this operates much more on a supply and demand sort of kind of more of a free market sort of way. We can see the red line, just the Fed sets it and it stays there, right? The SOFR rate moves around a lot. And the reason for this is the SOFR rate is indicating the supply of dollars relative to the demand for those dollars on an overnight basis, the shortest term possible. And so if there is let's take an example and say I am the only money market fund that has $10 billion willing to loan out to other banks, to other hedge funds, money market funds. I'm the only money market fund. I'm the only guy in town that's got those $10 billion. Well, in that case, I can charge a higher interest rate, right? There's all this demand. All these banks are coming to me saying, I need your $10 billion, and I'm the only guy in town that's got it. So the interest rate or the cost of those overnight dollars, I can charge a higher interest rate. And so the yellow line or the SOFR rate, this is much more of like a free market gauge of the supply of dollars relative to the demand for dollars. And then we're looking at the effective federal funds rate. This is a rate that the Fed sets for interbank lending on an unsecured basis. This is the interest rate for interbank, depository institutions like JP Morgan Chase, for example, to loan their bank reserves out to each other This is the interest rate that it costs to loan interbank lending of reserves. So, what are reserves? They are very important in the conversation that we're about to have here, looking at the price of the dollar itself. So, here we're looking at the reverse repo balance. So, this white line is showing the reverse repo balance. Over here, we were looking at the cost, right? The interest rate to use the reverse repo operation or facility. Here we're looking at the amount, the dollar amount that was used in that overnight reverse repo. And then we're looking at bank reserves in purple. And what I want to point out is we're going to look at 2019. So, starting in 2017, the Fed started to engage in quantitative tightening, which is what they've been engaged in now. As we can see, bank reserves have come in from their 2021 peak. Quantitative, just as QE or quantitative easing is the Fed printing bank reserves out of thin air, depositing those newly created dollars into a bank account, a reserve balance. Quantitative tightening is the exact opposite. So quantitative tightening is basically destroying and reducing dollars. And so, sure enough, in 2017, the Fed started to engage in quantitative tightening. Bank reserves came down. Now, remember, bank reserves are half of the monetary base. There's currency, physical currency, like your $100 bill you might have pictured when we were talking about the cost of a dollar. But then there's also bank reserves. So currency plus bank reserves is the monetary base. This is the most base level of the money supply, is the monetary base, the M0. And it declines when the Fed is engaged in quantitative tightening, just as it expands when the Fed is engaged in quantitative easing. Well, here we can see the reverse repo balance. So quantitative tightening was engaged, bank reserve balances were coming down. And what happened to the cost of money relative to the Fed funds rate? Let's look at 2019. So I did a video on the repo rate crisis if you want more in depth, but we can see that the yellow line, which is SOFR, again, this is the kind of much more free market supply and demand of dollars. We can see SOFR moved notably above the federal funds rate, which is the cost of money interbank unsecured overnight lending. SOFR was moving above that. And again, remember my example, I'm the only money market fund that I'm the only guy in town that's got $10 billion. Everyone needs $10 billion and I'm the only one that has it. I can charge a higher interest rate. So when SOFR is moving higher, this can indicate, like it did in 2019, as bank reserves were coming down, dollars were literally being destroyed. You could see that show up here, where SOFR, the cost of an overnight dollar on a secured basis, was moving higher, much higher than the federal funds rate, which again is that interbank unsecured lending market. We know that this culminated with an extraordinary spike in September of 2019, where on an intraday basis, it was even actually worse than this. It spiked to 9%. I will tag that video at the end. You can watch it more in detail. But the demand for dollars was way outpacing the supply of dollars, and this was due to bank reserves having declined because the Fed was engaged in quantitative tightening. And we can see SOFR was moving well above the federal funds rate. Well, then what happened? Then the Fed immediately, as soon as I'll go to September 2019, it was actually the bottom in bank reserves. In September of 2019, bank reserves were 1.39 trillion. Okay, they had been declining, being destroyed due to quantitative tightening. They were at 1.39 trillion. Well, the Fed immediately printed more bank reserves. They printed about 250 billion more in dollars and bank reserves. And that helped to reverse some of the stresses that we saw in September. And then everyone knows what happened in January, February, March of 2020. We know what happened, and bank reserves skyrocketed. They went vertical. They went from 1.6 trillion all the way up to 3.2 trillion. So $1.6 trillion was printed and created out of thin air just in those 2 or 3 months. So now there was suddenly an abundance, just as there was a shortage of dollars because bank reserves, half of the monetary base, had been declining, right? Dollars were being destroyed going into the repo rate crisis. Well, the exact opposite occurred. And now there was suddenly a flood of dollars entering the financial system. So look what happened to yellow, to SOFR. Well, it stopped moving so notably above the federal funds rate. We can see that here. It started to track much more in line while it had been spiking way above. Now it starts to move much more in line with the federal funds rate. And in fact, it actually even falls below the federal funds rate here in March of 2020. So we mentioned the red line and what that represents. That is the Fed setting a floor in the price of money. Well, if you see that the SOFR rate is falling below the federal funds rate, what this means is that there was such an oversupply or overabundance of dollars that everyone had them in the financial system. Everyone had dollars, no one had demand for dollars. And so, therefore, the interest rate that could be charged on those overnight dollars fell below the federal funds rate. So, technically, what this meant is you would have been able to, if you're the right kind of institution, you would have been able to go get a SOFR loan, right? 0.05 is your cost there, 0.05%. And then you could immediately turn around and go into the federal funds interbank market and loan it out at 0.15. Just theoretically, I'm not sure how much of that actually occurred because there was such an oversupply of dollars. But we can see that, going forward, fast forwarding, this trend continues. And we can see SOFR dips below the federal funds rate. It goes from a shortage of dollars and a too much demand and too little actual dollars, goes from that to the exact opposite, which is SOFR starts falling below the federal funds rate and actually falls to the floor that we established was the reverse repo rate. Remember, this is what the Fed is trying to say. The cost of money can never, the cost of an overnight dollar can never fall below that red line. It is trying to set a floor in the value of the dollar. Well, you might be seeing over here in 2022, you can see, and even here for a brief period in 2021, the yellow SOFR, which again is just the free market of supply and demand for dollars on an overnight basis, you can see it actually dips below the repo rate. So, what this is indicating is that the Fed is not actually all powerful. There was such an oversupply of dollars that the SOFR rate actually dipped below the reverse repo rate. And this trend continues. You can see from, it looks like the first time it happened was October 2021, and it continues all the way for 12 months, for over a year, before the Fed hiked rates enough to kind of tampen that easy money down enough that it stopped happening. But it went on for a year where SOFR was below the reverse repo. So what this means is that you, me as a money market fund, could go borrow overnight dollars at 1.45%. We're just looking at June of 2022 for an example. I could have borrowed dollars in the kind of free market of overnight dollar market, gone and borrowed at 1.45 and immediately turned around, take those dollars to the Fed where they will pay me 1.55. So I just made 10 basis points of basically free money. Now, 10 basis points, 0.1%, might not sound like a lot, but we have established many times how large the SOFR market is. At the time that this was going on, the SOFR market was around $1 trillion a day. It is now close to $3 trillion per day. Is $2.88 trillion per day. So this is a massive market. There's huge amounts of these kind of overnight dollar loans occurring. So on $2.9 trillion, 10 basis points is actually a lot of money. You're talking about millions, if not, hundreds of millions of dollars. So the Fed was able to eventually raise rates enough, right? They also started quantitative tightening as well to try to tampen down the kind of easy money conditions. And eventually they got it under control. So SOFR stopped going below the reverse repo, which again is in red. This is where the Fed is trying to set the floor for the price of money. And sure enough, they were able to get it under control, and we saw kind of this equilibrium where it was the SOFR rate was between the effective federal funds rate and the RRP rate, right? And it continued like that for most of 2023. But then we started to see some kind of pops where SOFR started to pop above the effective federal funds rate, and in some cases, meaningfully above. And we know the conditions recently, right, that we've mentioned, signaling tightness or lack of liquidity, where SOFR is moving meaningfully above the effective federal funds rate. This is indicating that liquidity conditions are getting poor. Money is getting tight. Everyone wants dollars, demands dollars in these overnight markets, but very few actually have the dollars, right? And we know that bank reserves have declined from their peak. They've gone basically sideways for the past 2 or 3 years. So you would look at the bank reserves and not really notice the liquidity strains. You have to look at some of these kind of overnight dollar markets to get a sense for those liquidity strains. And now the Fed also has tools to the upside. Just as we established the RRP was the Fed setting a floor in the value of a dollar on an overnight basis. You might remember the Fed's upper bound is 4.5%. So where is 4.5? You could see SOFR's at 4.4. How do they set that upper range? Well, here is the what's called the discount window rate. So just like the Fed is trying to set a floor in the reverse by changing the reverse repo rate, they can set a ceiling by using the discount window rate. This is that discount window you might have heard of before. It is kind of the lender of last resort, right? The Fed is always willing to loan money out currently at 4.5. No matter what happens, they are willing to loan you a dollar at 4.5. The reverse repo rate, on the other hand, sets the floor. No matter what happens, we will buy your dollar at 4.25. And what the discount rate is setting a ceiling. No matter what happens, we will loan you a dollar for 4.5. So by altering these two rates, when the Fed does a cut or a hike, they're not changing a single rate. They're actually changing, as you can see, the discount window rate and the reverse repo rate. Now, the Fed also engages in what are called open market operations. I figured that's kind of too wonky for this particular video, trying to go over kind of the basics here. There are also open market operations that the Fed will use to kind of influence the price of a dollar on an overnight basis. But the main points here are the reverse repo and the discount window rate. Now, there's another one here called the IORB. This is the interest on reserve balance, IORB, and this is in green. And what the IORB, now I wasn't paying attention to markets while this was going on, but from the papers that I've read, this IORB used to actually be below the federal funds rate. And it was used by the Fed much more to set a floor in the below the value of the dollar, right, on the downside. Well, now we can see the interest rate on reserve balance is actually above the federal funds rate. Now, what is this? We talked about bank reserves here in purple. We can see bank reserves. What this green line, all it's showing is the IORB rate. This is what the Fed is willing to give a depository institution, right? There are $3.2 trillion in bank reserves. This green line is showing, the Fed will say, okay, all that 3.2 trillion in bank reserves, we, the Federal Reserve, if you just leave it in your checking account with us, we will pay you 4.4%. So the fact that this is above the federal funds rate, to me, indicates that the Fed recognizes that the money conditions have gotten so easy. When you look at the balance sheet of the Federal Reserve, when you look at M2 money supply or M0, bank reserves and the monetary base, I think the Fed recognizes that we are primed for an inflationary event. Therefore, they are putting this IORB above the effective federal funds rate, which, if you think about it, this incentivizes JP Morgan Chase and depository institutions to keep that $3.2 trillion of bank reserves, to just keep it in the checking account, not do anything with it, not loan it out, not spend it, not do anything with it. Just keep it there in the account. Remember, big banks have an account at the Fed, like a checking account. That is what these bank reserves sit in. And what the green line is indicating, or IORB, is that I think the Fed recognizes that they kind of need to sterilize or incentivize, you could say. They need to incentivize the big banks to some margin, right? It's not a huge margin over the effective federal funds rate, 4.33 versus 4.4. It's only 7 basis points, but there is still an incentive there. The Fed is still telegraphing an incentive to the big banks. Hey, keep your dollars locked up in reserve balances in your account with us, and don't spend it. Don't loan it out. Don't do anything with it. So I think that this represents, a recognition that the risk to inflation, given the size of the balance sheet of the Federal Reserve, given how much money has been printed over the past 5 years, I think that this is one way the Fed is showing that they recognize the risk to inflation on the upside. Now, I wanted to note SOFR, again, this is that free market cost or value of a dollar, free market, supply and demand. You can see it actually moved above the discount window rate here in October 2024. Just as we saw SOFR move below the RRP, the red line, which is again supposed to be the floor, just as we saw the actual value of a dollar move below the floor, the yellow line, the SOFR, the actual value of a dollar, it can also move above the discount window rate, which is supposed to be the ceiling. So anytime you see that, it is noteworthy because again, these are the Fed's tools. The Fed's, these are, we're looking at them: discount window rate, interest on reserves, and reverse repo rate. These are the Fed's tools. So when you see something like the SOFR rate spike above the discount window rate, or when you see SOFR move below the reverse repo, or below the floor, or above the ceiling, that is indicating that something notable is going on. And clearly, what we've seen kind of over recent history is much more akin to 2019 and the liquidity shortage, a shortage of dollars, than an overabundance of dollars. We know that, by looking at SOFR relative to these rates, we know that liquidity conditions are getting tight. And the very opposite of what was going on back here, where SOFR was, 7, 8 basis points below the reverse repo rate. Well, now we're meaningfully above the effective federal funds rate and even above the IORB rate. And so here I will take off reserve balances and the RRP balance. Hopefully that relationship is clear. At the peak here, the Fed was, $2.5 trillion had been printed that was being sterilized by the Fed in the reverse repo operation. So the scale of this is quite massive. So here I'm going to put on SOFR minus Fed funds in red. And so what this red line is indicating is the spread. It's the same data we're looking at here with the yellow and the white lines, but this is representing it as a spread. What we can see is, again, the conditions that led to 2019 repo rate crisis I will mark it here in September of 2019. We can see the SOFR Fed funds spread blows out way up here to, what is that, 2.93, meaning the SOFR rate was almost 3%, 300 basis points higher than the Fed funds rate, which we're looking at in white here. That is that interbank unsecured lending rate. That was the 2019 repo rate spike. Well, if you look at the conditions, the spread, you can see that SOFR had been blowing out over Fed funds. As we established looking at it this way, right? You could see the yellow representing SOFR. You could see the tight liquidity. The demand for dollars was exceeding the supply. You could see that looking at it this way. This is just another way to look at it. You can see that the spread was widening, meaning the SOFR rate was higher and moving even higher than the effective federal funds rate. Well, look at what's been going on recently. So I will put a line here at 0 because this spread here can also indicate the exact opposite and go the other way, right? In reverse, what that is indicating is, again, there are too many dollars. The supply of dollars is vastly outpacing the demand for dollars, right? So it can go the other way. But what we've been seeing recently is much more of a spike of SOFR blowing out above the federal funds rate. Again, in my opinion, indicating that liquidity conditions are starting to get tight. Now, this is nowhere near, I would say, a cataclysmic sort of, oh my God, we got to worry about it sort of degree. But I think the Fed is probably watching this and keeping an eye on it. Now, we know QT is ending. My guess is that the Federal Reserve will probably hold and engage in neither quantitative tightening nor quantitative easing for some period of time, but eventually move in the direction of QE again. And finally, I will end here. There's this paper called From the Floor Back to the Corridor: Why the Choice of Monetary Policy Implementation Framework Matters. If you are a nerd like me, this was a paper that I found super helpful when I was trying to learn about all this. I will link that in the description. And just to end here, I had mentioned that the Fed is worried about kind of inflation risk to the upside. This is, look at this stat. So the Federal Reserve used to be a much smaller part of the economy and financial markets. Before the GFC of 2008, the assets of the Federal Reserve balance sheet equaled 6% of GDP. 6%. Now they equal 26%. Before the GFC, currency, right, dollars, printed physical currency, was over 95% of the Fed liabilities. Remember, every dollar you have in your wallet is a liability of the Federal Reserve. Now it is just 33%. So currency, dollars, the way you think of dollars, used to be 95% of the Fed liabilities, but now it's only 33%. Real dollars are only, physical currency is only 33% of the Fed's liability. So this paper is really interesting if you're interested in going really really in depth in some of these concepts. Things have changed since the GFC, and like I'd mentioned, the IORB is used differently now than it used to be. So this paper, goes through some of those historical changes and gets really nitty gritty. But anyways, I hope that that was helpful in at least trying to understand how this kind of vast $3 trillion overnight loan market works and how the Fed actually works. This is the plumbing for the dollar system. This is the plumbing for when you log into your Wells Fargo account, you see a certain amount of dollars in there. This is really what's running things. This overnight SOFR market, this overnight dollar market, repos and reverse repos, all of this kind of stuff that we went over in this video is really kind of what drives the real financial plumbing of the modern day economy. So I hope that was helpful, and I will catch you in the next one.